Have you ever thought that just spending a single pound could protect you from a major tax headache? I'm David, and what I'm about to share could genuinely save some of you thousands of pounds in surprise tax deductions. Right now, HMRC is sending out silent warnings, not through headlines, not through official-looking brown envelopes, but through missed details that are costing pensioners their hard-earned money. If you were born before 1959 and you're either approaching retirement or already drawing from your private pension pot, this update directly concerns you. Let me ask you, when was the last time you checked your tax code after taking money from your pension? If your answer is never or not sure, then you might be one of thousands of Brits unknowingly overpaying tax, simply because of how HMRC processes large lump sum withdrawals. But here's where it gets interesting. A £1 trick, yes, literally withdrawing just £1 from your pension before accessing a larger sum, could prompt HMRC to issue you an updated tax code and stop you from being taxed as if you earn tens of thousands in 1 month. It's a simple move, but it's helped many reclaim up to £3,000 or more in overpaid tax. HMRC recently revealed that pensioners claimed back £44 million in just 3 months. You see, when you withdraw a large amount from your pension, HMRC often applies an emergency tax code, assuming it's your regular monthly income. That means you could be taxed at a much higher rate, unless the system is updated first with a small, trigger, withdrawal. That's what this £1 is all about. It's not about the money, it's about what it tells HMRC. And here's the kicker, many pensioners don't even know they've overpaid. They either never claim it back, or wait months for an automatic refund, if they get one at all. Some are completely unaware until it's too late. So in today's video, I'll break down exactly how this £1 trick works, who qualifies, what steps you need to take to make sure you're not on the wrong tax code, and how to reclaim thousands if you've already overpaid. Before we get into all that, make sure you click subscribe and tap the bell so you don't miss more updates that could put money back into your pocket, not HMRC's. David here, and I believe every penny of your pension should stay exactly where it belongs, with you. Let's dive deep into why HMRC is telling many pensioners, especially those born before 1959, to spend just £1 from their state pension, and why this tiny action could save you from bigger tax headaches. It might sound strange at first. Why spend money deliberately? But stick with me, because understanding this could really protect your financial well-being. The UK state pension is designed to provide you with a basic income once you retire, and it's been a cornerstone of retirement income for millions. But here's the catch, the way the government handles taxation on that income has become more complex over the years, especially as personal allowances haven't kept pace with inflation and pension increases. So, first, let's talk about the personal allowance, the magic number that tells you how much income you can earn before you start paying income tax. Right now, the personal allowance stands at £12,570 a year. Sounds like a decent amount, right? However, this figure has been frozen for a long time. What that means is, even though prices and wages go up, the amount you can earn without tax isn't rising alongside them. Meanwhile, the state pension is increasing each year because of the government's triple lock promise. That guarantees your pension will rise by the highest of 3 measures, inflation, average wage growth, or 2.5%. So every year, your pension gets a little bump. That's good news for your pocket, but it comes with a twist. Because the personal allowance stays the same but your pension increases, you are gradually getting closer to the point where your state pension income alone could push you right up against, or even above, that tax-free threshold. If you add any other income sources, like private pensions, savings interest, or part-time work earnings, you may find yourself liable for income tax unexpectedly. For many pensioners, this is a new reality. Whereas before they could count on their state pension being tax-free, now a rising number of pensioners find themselves paying income tax on part of their pension or other income. HMRC data shows millions more pensioners are now inside the tax net than a decade ago. But what about that spend £1 advice from HMRC? Why would spending a tiny amount of your pension help? Well, HMRC has a system to collect tax from pensioners called Simple Assessment. This system automatically calculates if you owe any tax based on what the Department for Work and Pensions tells HMRC about your pension income. If your income is over the personal allowance, HMRC will send you a tax bill to pay. However, If the amount of tax you owe is very small, HMRC sometimes won't bother chasing you for it. It might write off the tax because it's not cost-effective to collect. That sounds good, but here's the problem. If HMRC decides not to issue a tax bill because your income is just below or barely above the allowance, you could unintentionally end up with unresolved tax liabilities. This might cause bigger problems later, such as penalties or confusion over your tax record. So HMRC's advice to spend £1 means, if you deliberately spend £1 of your pension income, you ensure that your total income crosses the threshold in a way that HMRC recognizes. This triggers the simple assessment process, prompting HMRC to send you a clear tax bill. Yes, you pay tax on that income, but this keeps everything official, preventing future misunderstandings or surprise bills. Let's break that down with an example. Suppose your state pension for the year is just under the personal allowance, say £12,569, and you have no other income. Without spending that £1, your income technically falls below the threshold, so HMRC might not send you a tax demand, potentially leaving some tax in limbo. But by spending £1, buying a newspaper, donating to charity, or even purchasing a small grocery item, you make it crystal clear that your income exceeds the personal allowance and should be taxed accordingly. This strategy isn't about wasting money, it's about protecting yourself from tax confusion. It's a simple way to ensure HMRC's records are correct, and you avoid problems down the road. Of course, this advice isn't for everyone. If your total income is well below the threshold, or if you already pay tax on your pensions and other earnings, you don't need to worry about spending the £1 specifically. But for many seniors on the edge of the personal allowance, it's an important tip to be aware of. Now, you might be wondering how this affects your overall retirement finances. After all, no one wants to spend more money than they have to, especially in retirement. But think of this £1 as a tiny investment in peace of mind, ensuring you stay in HMRC's good books and avoid unexpected tax bills later. You might also ask, what happens if I ignore this advice? Well, HMRC might delay or forego sending a tax bill if your income appears just under the allowance, but if later they discover discrepancies or additional income, you could be hit with a tax demand plus penalties or interest on unpaid tax. That's why it's smarter to be proactive. Another important point is that this tax situation affects only those pensioners born before 1959 because they received the old state pension system or are in a particular tax position. People born after 1959 are on different rules with the new state pension, so this advice may not apply in the same way. Now, you might also want to know about the other financial changes affecting pensioners. For example, the state pension triple lock is currently under political review. If the government changes how the pension increases each year, that could also impact your tax situation. So it's important to stay informed about changes announced by the Department for Work and Pensions or HMRC. Moreover, if you have other income sources, such as rental income, dividends from investments, or private pensions, those all add to your taxable income. That means the likelihood of exceeding the personal allowance increases, and so does the chance of receiving a tax bill. It's also worth mentioning that some pensioners qualify for additional tax reliefs or allowances. For example, married couples or those with certain disabilities might have different tax thresholds or benefits available. If you think you might qualify, it's worth speaking to a tax advisor or using free government guidance to check. Now, if all this talk of tax sounds overwhelming, don't worry, you're not alone. Many pensioners feel the same way. The key is to keep good records of your income, keep an eye on letters from HMRC, and take action early if you receive any tax demands. If you ever receive a letter from HMRC about your pension tax, don't ignore it. Contact HMRC or a trusted tax advisor to clarify your situation. Sometimes small mistakes in reporting income can be fixed easily. In summary, here's what you should take away today. The personal allowance is frozen, but state pensions are rising, so more pensioners are paying income tax. HMRC's simple assessment system automatically collects tax on pension income over the allowance. Spending £1 from your pension income ensures HMRC knows your income exceeds the allowance and sends a tax demand, preventing future problems. This advice mostly applies to pensioners born before 1959 on the old pension rules. Stay informed and check for letters from HMRC, and seek advice if unsure. Remember, this small £1 step can save you from much bigger hassle and stress in the future. It's about being smart with your money and protecting yourself. If you want to keep getting updates on important pension and benefits news, be sure to subscribe to my channel and hit the notification bell. I'll keep bringing you clear, easy to understand advice so you can enjoy your retirement without surprises. Thanks for listening, and take care of yourself and your finances. David here.